can options traders avoid expensive call options? Imagine paying a lot for a ticket to a concert only to find out the band is playing a different night. That's what buying costly call options can feel like if you're not careful. So, how do traders keep their costs down while still catching the upside of a stock? Well, understanding what makes call options expensive is the first step. Prices go up when the stock price is high, the time until expiration is long, or when implied volatility is high. Implied volatility is like the market's guess on how much the stock will move. When it's high, premiums tend to be higher too. To avoid overpaying, traders can use a few smart strategies. One way is to use spread strategies instead of buying a call outright. For example, a vertical spread involves buying a call at a lower strike price and selling a call at a higher strike price with the same expiration date. The money earned from selling the higher strike call helps offset the cost of buying the lower strike call. This way, you pay less overall. It also limits your maximum profit and loss, which can be a good trade-off. Another tip is to pick options with lower implied volatility. You can check volatility levels for different stocks or exchange-traded funds. When implied volatility is low or moderate, premiums are cheaper. Avoid buying calls right before earnings or major news events, because volatility often spikes then, making options more expensive. Choosing shorter expiration dates can also help. Longer-term options cost more because they give the stock more time to move in your favor. If you pick options around 60 to 90 days out, they tend to be less costly than those with many months or years left. But remember, shorter-term options lose value quickly due to time decay, so timing is key. Buying out-of-the-money calls is another way to save money. These calls have strike prices above the current stock price and are less expensive than at-the-money or in-the-money options. They requiring a bigger stock move to become profitable, but they cost less upfront. If you already own the stock, selling covered calls can generate income that helps reduce your overall costs. This means you sell a call option against your shares, collecting premium income. That income can offset the cost of buying other calls later. Also, pay attention to bid-ask spreads and liquidity. Options with tight spreads and high open interest cost less to trade because you're not losing money on the difference between buying and selling prices. By combining these tactics, traders can avoid paying too much for call options. Using spreads, selecting low volatility periods, choosing the right expiration, and considering out-of-the-money options all help keep costs down while still giving you a chance to profit if the stock moves up. It's about being strategic and understanding what influences option prices so you can make smarter, more cost-effective trades.